Shall we pray? Heavenly Father, we thank you so much for how far you have brought us. We thank you for the life that you have bestowed upon us. We that didn't deserve this life, we didn't deserve this grace. We thank you for the power. We thank you for the strength. We pray that as we are about to learn, you grant us the spirit of wisdom and understanding, the retentive memory, so that that very day we can be able to reproduce everything and pass our exam. And at the end, glory and adoration shall be given unto your name. This and many more we ask in the name of the Father and of the Son and of the Holy Spirit. Amen. We want to look at a very important topic today: ratio and analysis. When we started, I took you through the system of accounting or the accounting system. The system is very simple. You should know how to prepare the books of account. That is dealt with in level 1. Then the next stage is you should know how to prepare the financial statements. The elementary aspect is dealt with in level 1. Then in level 2, we do financial reporting. That is focusing more on the financial reporting of companies. So how companies prepare their financial statement. Then the next stage, because the financial statement can be separate or the consolidated. The next stage is to be able to interpret the financial statement that you have prepared. So not all of you will be preparing financial statement or auditing financial statement. Some of you go into consulting where you are supposed to advise, and this is one of the tools or instrument that you are going to use to advise your clients: analysis of the financial statement. So let's look at ratio and analysis. Ratio and analysis. What are the key issues that will be discussed? Key issues. Key issue number 1. We want to look at the ratios itself. What are some of the importance, advantages? The importance or advantages or advantages. What are some of the limitations? Limitations or disadvantages. Then we look at how should ratios be computed. Computation of ratios, where we look at the 5 main categories of ratios and the ratios under each of these categories. We are looking at accounting ratios. In fact, the underlying word is accounting ratios. Because in finance too, we have the finance ratio, like the Trenor and the other things. We have the finance ratios. We are looking at accounting ratios. Take note. So after dealing with this, now our concentration more will be on how to analyze. The analysis of the ratios. If you compute the ratios and you can't make meaning out of that, then the ratio becomes meaningless. So it's important we learn how to analyze. For financial reporting students, the computation now, the interpretation, the ratio is 20 marks. And whether you like it or yes, ratio and analysis will come. So the computation will take at most 8, or at your level 10, 8 and 10, between 8 and 10. Then analysis 10. Corporate reporting student, computation will take at most 6. The interpretation or analysis 14. So you take notes. Very, very important. Let's start. When we talk of ratio, we are looking at ratio and analysis. We've been hearing of ratio from elementary. So the first question is, what is ratio? A ratio is used to show the relationship between two elements or two items. Ratio. We use ratio to show the relationship between what? Two items. So we want to know the ratio of boys to girls. So if the boys are 40 and the girls are 60, we say the ratio is 2:3. For every 3 girls, whenever you have 3 girls in the classroom, you also see 2 boys. This is the relationship between the boys and girls in the classroom. If you come to accounting, if you say, let's say, current asset over current liabilities, let's assume that is 2/1. So the answer is 2:1. It tells you that for every 1 cedi current liability that you see, you can finance it with what? 2 cedi current assets. So showing relationship. If you take something like profit after tax over sales, then assuming you divide and you get 20% times 100%, so 20%, it tells you that it is 20:100. Therefore, it is just 1:5. It tells you that for every 5 cedi sales that you make, 1 cedi relate to what? To profit after tax. So ratios is used to identify or analyze the relationship between two elements. It shows the relationship between two items. So we are looking at the relationship between two items or elements. Now, the question is, what will then be what we call accounting ratios? Accounting ratios. Accounting ratios. Accounting ratios. When we talk of accounting ratios, we are then looking at the relationship that exists between elements of the financial statement. The relationship. This one, it is used to show the relationship. The relationship between the elements of the financial statement. So accounting ratios, it is used to show show the relationship. It is used to show the relationship between the elements of the financial statement. So now the question is, what are some of the importance of ratios? The importance or the advantages. I love to draw. So importance or advantages of ratios. Simple to compute. Very simple. They are simple to compute. It also helps in comparing companies with different sizes. That is the financial statement of companies with different sizes. Comparing companies with different sizes. Another thing that it does is that it helps to compare companies across. So now you can pick a company that is in Ghana here, then you compare the financial statement with another company that is in, let's say, Nigeria. So it helps in comparing companies in different locations. Okay. So basically, these are some of the advantages that we could get from ratios. Now, let's look at some of the disadvantages. We are still on ratios and analysis. Accounting ratios and analysis. So we are looking at the limitations. Limitations. The limitations or disadvantages of ratios. It does not present a uniform measure of performance. It does not present uniform measure of performance. Uniform measure of performance. Performance. So, particularly, others believe that when it comes to current ratio, the ideal ratio is 2:1. But it is not always true. It depends on the industry. In the real estate industry, where building is an inventory, then you are likely to have a ratio of over 1,000:1. You understand? Okay. Now, we are also saying that in the computation, if you take something like return on capital employed, return on capital employed, we know we are supposed to use profit before interest and tax. Profit before interest and tax. So others use what you call ROI, or return on equity. That is profit after tax over the capital employed. Others will also be looking at profit before tax. So these are all measures that is being used, and it does not provide a uniform ground for calculating the ratios and to even interpret the ratios themselves. So there's that lack of uniformity. The next one, we are saying that it will be very difficult to interpret if you don't understand the accounting policies that were applied in the presentation of financial statements. One of the challenges you are going to have is that every company has its own accounting policy. Therefore, it makes it very difficult for comparison because the accounting policy is by choice. So one of the challenges that you face is what you call different accounting policies. Then we're also saying that, you see, business situation includes complex pattern. It's a whole complex pattern on its own. So ratio analysis, accounting ratios, only considers the aspect of the financial statement. If you pick an annual report, financial statement is just a component of the annual report. Now, because it involves it involves a whole complex pattern, then we are saying that ratios cannot be used as the sole measure of the entity's performance. Therefore, we say that it is inadequate. Ratio alone is what? Inadequate to measure what? Performance. Ratio alone is inadequate. Alone is inadequate for measuring performance. Our next issue has to do with how to compute the ratios. How to compute the ratios. For the purpose of computation, ratios are grouped into 5. Ratios are grouped into 5. So we can look at the categories. So we look at the categories. Or the headings of ratios. These categories depends on what they measure. So if you are measuring the performance of a company, we cannot pick the company as a whole, then we measure the performance. For example, you want to measure the performance of AMA and then AC. You cannot as a whole say that AMA is better than AC. You are supposed to segregate AMA into sections. You can look at beauty. You segregate all of them into this section. You can look at beauty. You can look at intelligence in terms of education. You can look at religion. You can look at even the hometown where they come from, the ethnic. So many things. So, I mean, others will look at character, very important. So while somebody may be making a choice based on beauty and intelligence, and let's say character, others will be looking at religion, ethnic, and character, and ignoring beauty and intelligence. So you are supposed to segregate it into sections. It is possible Amma may not be good in all this. Amma may be good in an aspect and then weak in an aspect. The same thing applies to a company. You cannot single-handedly say that, oh, company A is better than company B. By all means, there is something good that company B2 is doing. So therefore, we segregate these things into categories so that we get to know how are they performing under each of these categories, or under each of these category, or each of these headings. How are they performing? So one of the areas that we will consider for the purpose of analyzing the financial statement of companies is their profitability. So we have what we call profitability ratios. Profitability ratios. Profitability ratios. We now look at how they are able to convert this profit into cash. So we look at liquidity ratios. Liquidity ratios. Then we look at how efficient we are internally. How are we efficient internally? Are our systems efficient? Management efficiency. How do we measure that? Okay, so we have what you call efficiency ratios. Others will call it activity ratios. It is used to measure our activities, whether our activities are okay or not. We want to measure each of our activities. One of the activities is sales. Are we doing well? Purchasing department, are they doing well? Marketing department, are they doing well? We are looking at our activity, how efficient we are in terms of the activity that we have lined up. We have investment ratios. Investment ratios. That is our ability to invest. These ratios will help us to know the ability that we have to invest. Are we a company that will attract foreign investors? Are we a company that will attract potential investors? We want to know if someone wants to invest in a company, what are the ratios that they should be interested of? Then we have gearing. Gearing ratio 2 is looking at your source of capital. Whenever you are going to borrow, you are going to borrow, they also be interested in this gearing ratios. It's very important. So whilst profitability ratios measures the profitability of the firm, liquidity is looking at how this profit is converted into cash. Then efficiency is looking at the efficiency and effectiveness of management. The systems that have been put in place, are they efficient? Are they giving us the desirable result? Then when we talk of investment, these ratios measures the ability of potential investors to come and invest into the firm. Is the company attractive enough out there for people to come in to invest? So one of the things we'll be looking at there is market price per share automatically. Then gearing. Gearing, we are looking at source of funds. Those who provide you with the source of funds, they are interested in the gearing ratios, the debt to equity issues, capital rationing, the ratios that has to do with debt to equity, the ratios that measures an aspect of debt and equity, how you have been able to combine the two. Very important. So basically, these are the 5 headings. It is important for us to look at the ratios under each of the headings. The ratios under each of the headings. Very important. So let's pick them one by one. Number 1, we are looking at profitability ratios. Profitability ratios. Under profitability ratios, we have the following. We have the gross profit margin, net profit margin, operating profit margin, and then return on capital employed. So we have what we call the gross profit margin, Then we have the operating profit margin. Then we have what you call the net profit margin. And the ROCE, return on capital employed. So these are the ratios under profitability. Now, I would want us to pick them one by one. It's not difficult. At all. So let's see. Let's look at the computation. So I have the ratio. Here. Then I have the formula. So I have the formula, and then how they should be measured. If it's increasing, is it okay? If it's decreasing, is it okay? We want to know. When do we say that the entity is doing well in terms of these ratios? Is the entity doing well because it is increasing? All those ones we are supposed to know. So measurements. So we take the first one, that is the gross profit margin. The gross profit margin is calculated as gross profit all over sales times 100%. Your answer will be in percentage. Answer in what? Percentage. We say that the higher, the better. When you talk of the gross profit margin, it measures the ability of the entity to make direct profit. We are looking at your ability to make a direct profit. We are looking at the profit that you are making on your goods. The reason why you are in business, the goods that you trade in, how much profit are you able to make on those goods directly when you sell for each element of your sale, or for each sale that you make? What is the direct profit included in these sales? We want to know. For each one CD sales made, what is your profit? That is the gross profit margin. So if your selling price is 20 cedis, selling price 20 cedis, we are asking, when you sell one product for 20 cedis, what is your profit element in that 20 cedis? Let's assume your profit element is 4 cedis. If it's 4 cedis, then 4 cedis over the 20 cedis times 100%, that will give us 20%. It means that your gross profit margin is what? 20%. For every 1 CD sales that you make a profit, a direct profit of what? 20%. It measures the ability of the entity to make direct profit, and that profit, we mean the profit that is on sales, the profit that is charged on sales, included in sales. That is what we mean by what? Direct profit. It is very important, because it is part of this direct profit that you are going to use to pay your operating expenses. You are going to use to pay all other appropriations, to have part for shareholders. So the higher your direct profit, the better. Very important. The gross profit margin is also used to measure the performance of one, the sales department and the purchasing department. The sales and then purchasing department, as well as the production department. We used to measure their performance. Okay. So this one will be measuring the performance of let me make it better for you. Okay. So we have the performance. Let me make this one responsibility. Responsibility. Who are those to be applauded? Who are those that you are supposed to ask questions if there is a failure? So under performance measurement, this should be performance measurement. Performance measurement. We are saying that the higher, the better. And this, you are supposed to measure the performance of the sales department, purchasing department, your production department. Okay, the next one is operating profit margin. Operating profit margin. This one too is measured as the operating profit over sales times 100%. The answer should be in percentage. The answer should be in percentage. Still, the higher, the better. This operating profit margin is used to measure the efficiency of management, in terms of generating internal profit. So this one should be in the bosom of the operations manager. Operations. The operations manager should be responsible for this, because we are looking at the efficiency of the systems that have been put in place to make sure that the reason why we are in business is to sell this product. So after getting direct profit on the sale of this product and deducting all the operating expenses, how much is left as operating what? Profit. It's very important. The operations manager, the manager for operations, should be responsible if there's a failure on the operating profit margin. It's very important. These are the areas that you are supposed to check. If the operation side is weak, then even though your gross profit, the sales department, purchasing, production, they are all under the operational manager. So if there's an aspect of weakness, then sometimes you will not see the gross profit margin failing, but the operating profit margin may fail. Something must explain that. I'm doing all these things because when we get to the analysis, you are supposed to analyze it well. The next is the net profit margin. The net profit margin, calculated as the net profit all over sales times 100%. The answer should be in percentage. Still, the higher, the better. We want to measure the performance of the entity in terms of the profit that is available after the payment of tax, the profit that is available for appropriation to owners, the profit that is available for appropriation to what? To owners. That is the net profit margin. The net profit margin. Very, very hot. Important. The net profit margin. After your operating profit, you add your other income. You get profit before interest and tax. You deduct your finance cost. You deduct your tax. Then you get what you call profit after tax. We want to know this profit after tax. If you express this as a percentage of sales, what will be the percentage? What will be the percentage? What will be the percentage? Very, very important. Now, you can see that when you talk of the profit after tax, who should be responsible? Who should be held responsible? Who should be held responsible? So we'll still give it to the operations manager. Why? Because the tax finance costs, there's nothing you can do about it. They are statutory, they are constant. Are you the one to determine the tax that you are supposed to pay? No, it's by law. The finance cost too, you have gone for a source of capital, and the return to the providers of capital, they have made it fixed. There's nothing you can do about this. So the net profit margin, usually is not a good measure of, performance in terms of assessing the performance of managers, assessing the performance of management. Yes, but we can use it to assess after all these taxes, after paying whatever we are supposed to pay to the debt holders, how much is left for appropriation to owners. Okay. So we will still blame the manager for operations. Not only him or her, we have other line managers who are also responsible for investment income, like the finance manager will be responsible for the external investment that is made. So here the finance manager will also come in here because of other income. But when it comes to finance costs and then tax, it is not within the control of the entity. It is not in anybody's bosom to determine that, or better still, you can't hold anybody responsible for paying higher taxes. Now we come to the main measure of profitability. That is the rules. The reason why you are in business is to maximize shareholders' worth. We want to maximize the worth of shareholders. That is why we are in business. Rules. Return on capital employed. This is calculated as, take note, we can't change this. This rules. Any other thing is no rules. Return on capital employed is calculated as the profit before interest and tax all over the capital employed. The capital employed is shareholders fund plus non-current liabilities. Take note of that. We are looking at the providers of capital, the external source of capital. We have shareholders, then non-current liabilities. These two. So times 100%. The answer should be in percentage. Answer in percentage. Alternatively, the rows can also be calculated as the profit before interest and tax all over, the capital employed, shareholders fund plus non-current liability is the same as picking total asset minus current liability. Take note. So we can say over total assets minus current liabilities. So times 100%. The answer should be in percentage. The higher, the better. The higher, the better. Management should be responsible for this. Management and the board of directors. Because you are in business to maximize shareholders' worth. And the shareholders know that they cannot, all of them put together, come and work in that business. Even if they have the expertise to man the business, because they are many, all of them cannot come and man the business. So they appoint who we call the board of directors. And the board of directors are supposed to give the policy direction of the company. And the board of directors also we have management. Those who are always there in the business. We are saying that whatever that happens to the maximization of shareholders' worth, management and the board should be responsible. So return on capital employed is used to measure the ability of the entity to maximize shareholders' worth. How the entity has been able to maximize the worth of what? Shareholders. Not only shareholders, but we're also looking at the providers of capital because of debt holders. So how they have been able to maximize shareholders' worth and to also maximize the returns that should go toward the debt holders. So how the company has been able to maximize the worth of providers of capital. So when we say providers of capital, we are looking at both debt holders and then shareholders. Very important. So that is for profitability ratios. Profitability ratios. Let's quickly run through the rest. Then when we get to analysis, we take our time to learn how to analyze. Profitability usually has a link to most of the ratios. That is why I have to take my time like this under profitability. Let's look at liquidity. We are still under ratios and analysis. Accounting ratios and analysis. Accounting ratio and analysis. Now, we want to look at liquidity ratios. Liquidity ratios. Under liquidity ratios, we have the following. We have the current ratio, we have the quick, or what you call acid test ratio. Then we have the periods, those periods that we know. You understand the aspect of all the periods that we know. So the period, we have the inventory turnover. Don't forget that the liquidity ratio that we are referring to here, others will call these other names, but they are still they are still liquidity ratios. So we have the turnovers. We have the turnovers. We have the inventory. We have the inventory turnover. We have the debtors collection period. Then we have the creditors payment period. Okay, let's pick them one by one. So let's pick current ratio. Current ratio is just current assets all over current liabilities. We expect the answer in ratio. That is A is to B. Answer in a form. in the form of A is to B. So that you should leave your answer in ratio form like this. So when you divide current asset over current liabilities and you get, let's say, 3.2, so that your answer is 3.2 is to 1. You understand? So let me even change the B to 1 so that you understand. So A in the form A is to 1. So whatever answer that you get is to 1. Okay. What does the current ratio measure? It measures the ability of the entity to meet its short-term obligations as and when they fall due. So the higher the better. But it shouldn't be too high. Once it is too high, then we'll be looking at some inefficiencies in terms of working capital management. But when we talk of working capital, we are referring to the management of current asset as against current liabilities. So if you're unable to manage this well, then you have a problem. So you should maintain some level of what? Current ratio. Okay. So this is a formula. And then performance measurements. Okay. Now we have quick or asset test. We are not supposed to look at the financial statement of banks. So when we talk of quick, we are looking at how fast you can be able to meet your short-term obligations as and when they fall due. So that one we'll be looking at the current assets minus inventory all over current liabilities. Because it will take time to convert inventory into cash, we take it out. But in the case of a bank, they are not into buying and selling products like companies do. So inventory will not be a major part of their business. Because of that, in the case of a bank, when you are calculating the quick or asset test, you have to deduct the debtors, the loans that they are provided, the receivables. You have to take it out because that is the reason why they are in business. In the other companies, the inventory is the reason why they are in business. So the stock that they have want to take it out because it will take time to go through the cycle again to get your cash. Okay. Others say that the current ratio, that the ratio is 2:1. The quick ratio, the ratio is 1:1. We still don't have the generally accepted ratio to accept. I mean, for us to accept in our analysis. Technically, the most important thing is the industrial average. The industry average that you'll be given in the question. You use that one as the basis for measuring the performance. That, okay, company A is doing better than company B, but not as much as the industry average, or they have even done better than the industry average. So the industry average becomes our benchmark for performance. Yeah. So this one, we are saying that the higher, the better. However, If it is too high, it means that you are not efficient in managing your asset and liabilities. You are not efficient in working capital management. Then we have the inventory turnover. Inventory turnover. As the name implies, we are looking at the number of times that you are able to turn over your inventory. The number of times you're able to go through the accounting cycle every year, the number of times. Okay, so here we are saying that we have two computations and we have different way of measuring it. It's very important. Okay, let's see. We can compute it as the average inventory over cost of sales times 100%. This one, the answer will be in percentage. We can also compute it as the average inventory. Sorry, let me turn it that way around. You can compute it as cost of sales all over average inventory. Let me say it emphatically. Average inventory is that opening plus closing over 2. But usually when we give you 2 years, you are not able to ascertain the opening inventory of the previous year. So in that sense, you use closing throughout. Use your closing inventory for your analysis. Because you cannot say that the current year you are using average and then the previous year you use the closing alone. You just use only the closing as your average inventory. Some will say closing plus 0 over 2. It's wrong. It is wrong. It's never done anyway. So just the closing. You use the closing to represent the average of inventory. Okay. Now, if it is cost of sales over average inventory, then the answer should be in times. It's very important. This one. The answer should be in times. In fact, this one, let me change the percentage because this is not what you see in your exam. So, this one, let's make it times period. So, answer in period. So, the period can be 365 days. Sometimes they will tell you that assume 360 days in a year. That means you can't use 365. It can be 52 weeks. It can be 12 months. For the purpose of your exam, you may not have a discretion. They may give you in that the industry average. So you have to check the industry average that was it calculated in days, in weeks, in months, or it was in times. If it's in time, then you need to use this formula. Cost of sales over average of inventory. If it is in period, that is whether it's in days, weeks, or months, then you are supposed to use this formula. Okay. Okay, so let's see. If the answer is in days or in period, if calculated in period, then we are saying that we once it is measured in period, then we are looking at how long it takes you to turn over one set of inventory. So the longer the period, it means that you are not doing well. So if the answer is in period, if it takes you a very short time to turn over, then it means that you are doing well. So if the answer is in period, or if calculated in period, then the shorter the turnover period, the better. But if the answer is in number of times, then ideally we are saying that when you turn over many times, it means that you are doing well. So if calculated in times, we are saying that the higher the number of times, the higher the number of times, the better. I could have done slides and then I'll just be scrolling it for you. But I want you to have the classroom experience. In fact, we are bringing you classroom experience at your homes. I would want you to feel it. That is why I am taking my time to explain everything as if we are in the face-to-face. So take note, follow me. Okay. Debtors collection period. Debtors collection period. Under the debtors collection period, we are just looking at average debtors. So when we talk of average debtors, we are looking at opening debtors plus closing over 2. However, most of your questions is just 2 years. So you didn't have the opening for the previous year. You can't have it. When you are dealing with the previous year, the closing will be there, but the previous the opening inventory you can't get. But you know the current year, you get the closing, and the closing for the previous year become the opening for the current year. So in that sense, you just use the closing. Since you cannot calculate the average for all, you just use the closing inventory as the basis of your computation instead of using the average. Okay. So we are looking at the average inventory all over. The question is, what gives rise to debtors? We are looking at credit sales. Credit sales. Where credit sales is not given in the question, you assume all sales to be on credit. So you use total sales. I'm saying that where credit sales is not given, you use total sales, meaning you are assuming that all the sales are on what? Credit. Very simple and what? Straightforward. So time the period. And the period we are talking about here can be days, months, weeks. So the answer will be in what period. We are looking at, oh, did I write average inventory? Should be average debtors. This should be average debtors. We are looking at how long it takes the entity to collect its debt. How long it takes the entity to collect its what? Debt. So this one you are supposed to use to measure the performance of your credit control department, your credit control systems. So debtors collection period. So this one, you say the shorter the period, the better. The shorter the period, the better. It is used to assess the effectiveness of credit control systems, to measure the efficiency of the credit control department. Then we have the last one, that is the creditors payment period. The creditors payment period. This one too is the same. We are looking at average creditors all over credit purchases. Where you don't have credit purchases, use total purchase. Where you don't have total purchase, you use cost of sales. So you multiply by what? The period. This one, the longer the period, the better. But don't forget, once it is too long, your credit worthiness may be affected in the long run. The longer, the better. It's used to assess the negotiation ability of the entity. However, do not forget, let me write this. If it is too long, your credit worthiness would be affected in the long run. Very simple and straightforward. So these are the liquidity ratios. Let's look at efficiency ratios. We are still on accounting ratios. Accounting ratios and analysis. Okay. So let's look at it. The next one is efficiency, or what you know to be activity. The liquidity, others call it short-term solvency ratios. Short-term solvency ratios. Short-term solvency. So if you go and you don't see liquidity, you see short-term solvency, please. We are referring to liquidity ratios. Okay. So under efficiency or activity ratios, we are looking at the key one here is asset turnover. That's the only one I'll be talking about. The rest we have dealt with it under we have dealt with them under liquidity ratios. So all the periods they are here. So inventory turnover is also under efficiency. The debtors collection period. Debtors collection period is an efficiency. Then we have the creditors payment period. The creditors payment period. The creditors payment period. Okay. Now, let's pick the asset turnover since the other three had already been discussed. Asset turnover. The formula. We have two formulas. One and then two. Okay. So formula number one. Asset turnover is equal to sales over total assets times 100%. So number one, we are measuring it in percentage. In percentage. In percentage. So once it is in percentage, we are looking at the whole asset turnover. Is looking at how the entity has been able to utilize its assets to generate revenue. How much revenue have we generated from the use of the asset? It is very important. We are looking at the value in use. The value in use. The cash flows that have been generated from the asset in terms of what? sales revenues. That's what we are referring to as what? The asset turnover. So you are saying that you've made sales of 50,000. That is for A. B is saying that he has made sales of 70,000. Is it now to say that B is doing better than A? We must look at the ratio, the asset base. There's a saying that he who much is given, much is expected. So let's assume that you have a total asset base of 200,000 here and a total asset base of 350,000. Express this as a percentage and see. This should be 25%. This should be 70 over 5, so 20%. So asset turnover will tell you that A is rather doing better than B. A is doing better than B. Okay. So if the answer is a percentage, then we are saying that the higher the ratio, the better. The higher the ratio, the better. Let's look at the option 2. Option 2, we are calculating it in times. So when you go, you need to check the industrial average, the industrial average that has been given. Is it in times or it is in percentage? So in times, we are saying that asset turnover is equal to the total assets all over what? All over sales. We want to know the number of times the total asset is able to cover the sales. So as you generate more revenue, you see that it will be reducing the number of times. As this sales keeps on increasing, it will be reducing the number of times. And the sales is our key performance indicator. Once sales is increasing, it means that you are doing well. So if the answer is in times, then we are saying that the lower the number of times, the better. The lower the number of times, the better. You see the scenario that I just gave. We said A is doing better than B. Let's look at in times. In times, it will be 200,000 over 50,000. So A will be 4 times. Then B will be 5 times. We are saying that the lower the number of times, the better. So A is doing better than what? B. As simple as that. Sacrosanct. Simple. Simple. So that's about the efficiency ratio. We've already talked about inventory turnover, debtors collection period, creditors payment period. So one key ratio that you always see and the efficiency is asset turnover. Asset turnover. So learn how to interpret this well and then calculate it well. It measures the ability of the entity to utilize the asset to generate revenue. In fact, the asset turnover measures the value in use of the company, how the entity has been able to use its total assets to generate revenue, the value use of the company. You want to know the revenue that you have generated, how you have been able to generate what? Revenue. Okay. Now let's look at investment ratios, or others call it the growth ratios. We are still on accounting ratios and analysis. Okay. Okay. We are on investment ratios. We are on investment ratios. And the investment ratios, we'll be talking of earnings per share. Earnings per share is a whole topic on its own, so I won't talk much on it. IAS 33, we'll pick a whole topic on that. It's in fact, it's a whole topic. IAS 33, earnings per share. So we'll look at market price per share. We'll look at earnings yield, dividend yield, earnings per share, this market price per share, this earnings yield, this dividend yield. We have the PE ratio, the PE ratio. PE is price earning ratio. The price earning ratio. That's the PE ratio. Now let's pick them one by one, as we've been doing, one by one. We can even add dividend per share. Dividend per share. Okay. So we have the ratio. The ratio. And then how it should be computed. The formula. Very important. So let's take earnings per share. Earnings per share is the total earnings over the total number of shares. Total earnings here means profit after tax minus irredeemable preference dividend. So all over the number of ordinary shares in issue. All over the number of ordinary shares in issue. Okay. The answer should be cedis per share. The answer in cedis per share, or the currency per share, the currency that you are using. Okay, let's take the next one. We have the market price per share. That is market capitalization all over the number of ordinary shares in issue. Or it can also be earnings per share over earnings yield, or it can also be dividend per share over dividend yield. Dividend per share over dividend yield. It's very, very hot. Important. Very important. We can also say or PE ratio times earnings per share, market price per share. This how we calculate it. When we calculate earnings yield, dividend yield, you see what I'm talking about. It's just a matter of change of subject. So don't worry about that. Okay. Let's look at earnings yield. When we talk of a yield, please take it from me. When we talk of a yield, we are looking at the number of shares that you can acquire from that item. That is your yield. The number of shares that you can acquire from that item. In fact, that is your yield. Your yield. Can express it in percentage. If you multiply by 100%, I mean, you are going to get it in percentage. But it tells us your yield, how much you are going to get in terms of the number of shares. So anything yield is anything per share over market price per share. Anything yield is anything per share over market price per share. So earnings yield becomes earnings per share over market price per share. So you understand why when you do the change of subject, you will get this. When you do the change of subject, this one, see that it's equal to earnings yield. So when you do the change of subject, it will be like this. Earnings yield is equal to earnings per share over over market price per share. So when you do the change of subject, you see that market price per share is equal to earnings per share over earnings yield. That is what I stated here. It's not magic. Okay. Okay. So earnings yield is equal to earnings per share over market price per share. We have dividend yield. Dividend yield will be equal to dividend per share over dividend per share all over market price per share. Then we have PE ratio. That is very simple. The formula, the name says it all. PE ratio, price earning ratio. So it is market price per share all over the earnings per share. It can also be computed as 1 over the earnings yield. Because when you turn it outside and look at the earnings yield, the reciprocal of the earnings yield is the P ratio. So this one too can be calculated as 1 over the PE ratio. There is an inverse relationship between the P ratio and the earnings yield. There's an inverse relationship. You have to take note. There's an inverse relationship. It's very important. Okay. Then we have dividend per share. We have dividend per share. Dividend per share is total dividend all over number of ordinary shares, or we have what we call payout ratio. Payout ratio times earnings per share. Payout ratio is just the dividend that you have paid all over the total earnings. Total earnings, we are just referring to profit after tax minus irredeemable preferred dividend. So payout ratio, that is it. Payout. I'm a ratio. They are not difficult. These are not difficult at all. Okay. So that is the computations. Let's look at the performance measurement. Here, most of them confuse themselves. That's why I didn't write it alongside. Performance measurement. Earnings per share, the higher the better. The higher the better. The earnings that is available to ordinary shareholders for each ordinary share that they hold in the company. If that earnings is higher, it means that the entity is doing well. Market price per share. The shareholders, the shares that they hold, if they are going to sell, what is the market price, the price on the market? If it increases, like for example, in the midst of the COVID-19, we show that the market price per share of Zoom had increased. I mean, it has really increased. It has gone far. It keeps on increasing. It's been increasing since the COVID-19 came because more people, organizations are resorting to the use of what? Zoom. So market price per share, once it increases, the better. The higher, the better. Earnings yield, the higher, the better. Dividend yield. You see, the dividend that you pay depends on your dividend or policy. But in ordinary terms, who amongst you out there will not be interested in higher dividends being paid? It's good. Just that we also expect that the entity should keep some maximum amount of retained earnings, because we know that retained earnings is the cheapest source of what? Finance. So the higher, the better. But depends on dividend policy. Dividend policy. PE ratio. This one, the lower, the better. That is giving the market price per share to be constant. Then we expect that your earnings per share should increase. And once it keeps on increasing, we expect that the P ratio will be lesser. Then we have the dividend per share. Dividend per share. That one also will depend on the dividend policy. So the higher, the better. The higher, the better. It is affected heavily by heavily by the dividend policy. By dividend policy of the organization. Very simple and straightforward. Very, very simple and straightforward. Okay. So that is that. Very simple. That is investment ratios. Growth ratios. It measures the ability of the entity to grow, because that is what potential investors will be using to make decisions. Investment ratios, growth ratios. You want to invest in an organization where you don't expect any growth? No. Let's look at the last aspect, that is gearing. The gearing ratio. So accounting ratios and analysis. Okay. So gearing. We are on gearing ratio. Others call it the long-term stability ratio. Long-term stability. Long-term stability ratios. Long-term stability ratios. Okay. So under long-term stability ratios, we are looking at the ratios that is mainly for the providers of capital. The providers of capital are interested in these ratios. Number one, we are looking at debt to equity ratio. The debt to equity ratio depends on the capital structure of the company, how the entity intends to ration between equity and debt, whether you want to be lowly geared or highly geared. Highly geared means that you are using more debt than equity. Lowly geared, it means that you are using more equity than debt. So one, we are looking at debt to equity ratio. The debt to equity ratio. Debt to equity ratio. Now the next, we'll be looking at the fixed dividend cover. The fixed dividend cover. Then we have the ordinary dividend cover. The ordinary dividend cover. Be taking note of some of these. There's one that we call proprietary ratio. Proprietary ratio. This one not everyone knows. So proprietary ratios. Proprietary ratios, it measures how the asset is being financed. That's all. It's just the debt to equity. We are looking at how the asset is being financed. So we will be measuring the total equity over total assets. Over total assets. Or we look at debt. Total long-term debt over total assets. This two is what you call proprietary ratio. Proprietary ratio. Proprietary ratio. Okay, let's pick that one by one. Let's look at debt to equity. Debt to equity ratio. So we are looking at debt to equity. The formula. And the debt to equity, we are just looking at total long-term debt. So what you mean by total long-term debt is non-current liabilities all over equity. Total equity. It could be in percentage. If the debt to equity is 40%, debt to equity, debt percentage of debt to equity is 40, then what will be equity? You should know those things. So let's see the answer. We expect that the answer should be in the form of A is to B. Answer in a form A is to B. Expect the answer should be in this form, like 2:1, 3:1. I getting it? Very simple and straightforward. Debt to equity ratio. So if it's, let's say, 40,000 over 60,000, you say debt to equity is, when you cancel, you say you get 2/3. So debt to equity is 2:3. It means that the company is lowly geared because the debt is less than what? The equity. I'm saying that in case, for example, you have 40,000 and 60,000 as the debt and then equity, then we are saying that the ratio will be 2:3. This tells you that the organization is lowly geared. Lowly geared because the debt is lower than what? The equity. Okay. This one depends on the capital structure of the company. Depends on the capital structure of the company. Note well, the long-term debt must exclude Deferred tax. It must exclude what? Deferred tax. Deferred tax. Deferred tax is just an accounting measure. It's not something that you'll be paying in the future. So deferred tax, once you see it, it should be out. It should not be part of your long-term debt. Please, it should not be part of your long-term debt. Usually you see it as part of non-current liability, but don't add it. Please take it out. If you have deferred tax, please, I'm begging you, take it out. I'm saying that debt to equity, this one depends on the capital structure. Capital structure of the entity. There should be evidence. This is evidenced in what you call the fixed interest cover. You see that in the fixed interest cover, if the entity is highly geared, you are likely to have a lower fixed interest cover because the interest that will be paid will be very high. Because of that, if you are looking at fixed interest cover, which is the number of times the profit before the payment of the interest covers that interest. Because we have higher interest, that number of times is going to reduce. And the evidence, you can get it from the debt to equity, is because the entity has a higher amount of debt, or assuming they added additional debt. Okay. Then we have what you call the fixed interest cover. I think I didn't write the fixed interest cover here. That should be here. Fixed. Okay, I can just. Fixed interest cover. The fixed interest cover. Fixed interest cover. Okay. Now, under fixed interest cover, how do you calculate it? We are looking at the profit before interest and tax all over the finance cost. The answer should be in times. Answer in times. We want to know the number of times the profit before interest and tax will cover the finance cost. This one has a direct link with debt to equity. It has a direct link with debt to equity. So you take note of that. Take note of that. Okay. You are looking at finance cost. Finance cost, or what you know to be interest expense. Then we have the fixed dividend cover. Fixed dividend cover. The number of times the profit available to pay dividend. The number of times the profit available to pay dividend covers that what dividend. So fixed dividend cover, we are looking at the dividend that is fixed. So we are looking at irredeemable preference or dividend. That's what we are looking at. So profits after tax all over irredeemable preference dividend. That is fixed dividend cover. Very, very important. We are looking at the dividend that is fixed, and we can talk of irredeemable. Don't forget the finance cost that we talked about and the fixed interest cover. The finance cost must include fixed dividend on redeemable preferences. Fixed dividend on redeemable preferences. So we have the fixed dividend cover. Fixed dividend cover, we are looking at the irredeemable preference dividend. That's what we are looking at. Because the redeemable preference dividend, that one is added to finance cost. Take note of that. Okay. Now we look at the proprietary ratios. I think I've already indicated that. That is the total equity over total asset and or debt over total assets. That's all we are talking about. Very simple. Okay, so in summary, we have looked at how to compute profitability ratios. 2, liquidity ratios. Liquidity ratio is also known as the short-term ratios, short-term solvency ratios. Short-term solvency ratios. Please, I said short-term solvency ratio. So when you go and you don't hear liquidity, I beg. We've also looked at efficiency ratios, which is also called the activity ratios. We've looked at investment, which is also called growth and expansion ratios. Growth ratios. Then we've looked at gearing. Gearing is also known as the long-term stability ratios. Now, how do we interpret financial statements? How do you interpret? Using ratios, accounting ratio. How do you analyze the ratios for the purpose of your exams? How do we interpret ratios? I would want to take you through this. Take your time and understand. What I would do is that I'm taking you through how to analyze the ratio nicely. After that, you have 2 questions there. One, you are supposed to compute the ratios and interpret. Then one, I've computed the ratios for you. You have to just interpret. When we meet, this one, I don't want to do it in the video, so that I would want to solve it alongside with you so that I take your questions. When we meet, I'll pick the one that you are supposed to compute and interpret. We do it together. Then I take your questions. By then you would have gone through, so that as we solve, if you have questions, you ask them. Then we'll pick the one without the computation. They have computed it for us. We concentrate more on the analysis, how to analyze. Whether you like it or yes, you have 20 marks solid on ratio and analysis. That is why I brought you to week 1, so that you can get it, practice more questions, and be fine. Okay, let's learn how to interpret. Let's learn how to interpret. So, in fact, before we even look at the interpretation, this is how you are supposed to present your work in terms of the computation. Presentation of computations. Presentation of ratio computations. This is what you are supposed to do. You pick the name of the ratio. So the ratio will be here. You state the formula. Then you compute. If it's for 2016, 2017. If it's for 2016, you do that. Or if it's for company A, you bring it and then you calculate. Then you do that of 2017 or B, depending on how it has been arranged. This is how you do it. So when you pick something like rows, you give us the formula. After that, you compute it for A and B, or 2016, 2017. In that order, you pick current ratio. You should present your computation in this format, so that you always score the 4 marks. Whenever we are giving marks for clarity of expression and presentation of material, can be considered. Present it nicely like this. Don't say rows, you state the formula, then you compute under it. No. Kolo. Present it in a table form like this. Let's look at how to analyze. Analysis of ratios. So let's see. So under analysis, in fact, in your exam, you'll be asked to write a report. It could be a memo or a report assessing the performance of the entity as against that of the competitor, or assess the performance of the entity for as against that of the previous year. So how do you write such a report? That is the analysis we are talking about. So key issues. Issue number 1. Your report should have a title. So you write on top, report. Very important. Don't just start, but no, it should be there, report. Then 2, you are supposed to give it an introduction. And you know, the title should also include from who to who, the caption that you give, that is the heading or the title that you give, and then the date. All of them should be there. Then we look at introduction. After reading the introduction, as you know all what you are going to discuss, as you have a fair idea of the discussion that you are going to do or the analysis that you have done, it's very important introduction. So the title and introduction will take a maximum of 1 mark. Sometimes they can give you 2. A maximum of 1 mark. Then we move on to the analysis, rather the content analysis. Content analysis. Under the content analysis, you'll be telling us a lot what the ratio represents. You do mathematical analysis and you tell us what it means and all those things. So this is where the main work is. Then you come and tell us that it's all about the content analysis. After that, you conclude. That's all. You conclude. That's all. So the 4 marks here, this one will take about 17 marks. Then your conclusion can take 1, or sometimes we don't need it. It can be added to the introduction and title. Let's look at the content analysis. Very, very important. Let's look at it. So now this what happens. The title. I'm picking them one by one. Title. So report. And the line is like this. From, to, the date, and then subject. So subject, and then the date. So from who? You can write your name. You can say that as a consultant, write a report to the ordinary shareholders of OneTouch. So it means that your position is consultant. So you can write Robert Consult. Then to who? The shareholders of what? Shareholders of OneTouch. or the board of directors of OneTouch. The two will be given in the question. Then subject. The subject, we want it in a research form, like assessing the performance of OneTouch for the year 2016-2017. Assessing the performance of OneTouch as against that of the competitor. Assessing or analyzing the performance of OneTouch, evaluating the performance of OneTouch. You see that I'm going with the ing form of the verb. Very, very important. So I can say from, let's say, Robert Consort to, let's say, the board of directors of OneTouch. Subject: assessing the performance of OneTouch for 2017 and 2016 financial year. Date: let's say 3rd January. January 2020. I can also write January 3, 2020. Don't go and be writing unnecessary date, please. Don't go and be writing short date. That will be unnecessary for us. 30, they will write 30-02-2020. Adding, it's a report, official report. Then they will do like this. What? You come and meet us there. So we look at introduction. What goes into what? Introduction. So this is title. Let's go to introduction. We are still on analysis of ratios. Analysis of ratios. So we have introduction. Introduction. Let's look at what goes into the introduction. You are supposed to tell us what you are going to do. So what are you supposed to tell us? 1. You are supposed to tell us the type of analysis you are going to do. You are supposed to tell us the type of analysis. You are supposed to tell us the coverage. The coverage of the analysis. I told you that the whole organization is divided into the 5 categories. Is your analysis going to cover all the 5? or 3 or 2, let us know. Then 3. If there is anything that will make comparison very difficult, let us know. Is there anything that would make comparison difficult? How do you resolve it? Very important. The third part, you see it more in ACC questions. What will tell you that there was a fire outbreak? Because of the fire outbreak, the entity may have incurred so much in terms of losses because of the losses caused by the fire. Because of that, it would be inappropriate to say that the entity didn't do well. So this will make comparison very difficult. You should state it in your introduction. Then you tell us how you have resolved it. The best way of resolving this is to be comparing the performance before the fire and the performance after the fire. That is the best way to resolve it. Very simple. So let's pick them one by one. So under introduction, we want to know the type of analysis. The type of analysis. Are you going to do trend analysis or intercompany? Or intercompany analysis? Trend analysis or intercompany what? Analysis. Don't go and use vertical and horizontal to confuse yourself. Please. Trend analysis or intercompany what? Analysis. Trend analysis, we are looking at comparing your own financial statement year by year. That is comparing one company's financial statement. Comparing current and previous year performance of the same company. That's what we mean by trend. Then we look at intercompany analysis. This one we are comparing across companies. That is, we are comparing two companies. You are comparing a company to that of its competitor. Comparing a company to its competitor. Whether trend or intercompany, it may include the industry averages. Whether trend or intercompany, the question can include the industry average as a benchmark. As what? A benchmark. Very, very important and what? Straightforward. Very simple. Very simple. So your analysis, introduction. So I go like my first, you see, some 1, 2, 2 lines you are done. And I write my title, that is my report from today's subject. They are there. You say report. You know, if it's a memo, ideally you expect that you start with 2. Memo should always start with 2. If it's a report, it will be from 2 in that order. It could also be 2, no problem. Okay. So introduction. I just say that this report includes a trend analysis of One Title Limited for the year 2017 and 2018. If there's a national average, I just add that together with the industry average, full stop, or together with the industry averages, full stop. I'm done. You ask, you have to answer that. Don't forget, it's 1 mark, maximum 2 marks. So don't talk plenty. Hit it on the nail. The type of analysis. Maybe you are doing an intercompany analysis. This report includes an intercompany analysis of One Title Limited and its competitor, Tips Limited, together with industrial or industry averages. Full stop. You are done. For the introduction, one part of the introduction. This will take not more than 2 lines. Then the next aspect of the introduction is that you tell us the coverage. The coverage. The coverage, we want to know the categories that your report covers. So let me look at the coverage. The coverage. I'm still on introduction. So the coverage. We are looking at the categories or headings. The ratio categories or headings covered by your analysis. So the analysis covers profitability, liquidity, and gearing. Full stop. The analysis covers, let's say, profitability, investment, and gearing. Full stop. You don't talk plenty because you are going to pick profitability and discuss all the ratios that you have computed under profitability. Take note. So just simple. Now you tell us if there's anything that will make comparison difficult. I mean, like I told you, fire outbreak. Don't tell us that there's emergence of a competitor. We expect that in business there should be competitors at any time. New entrant is not an unforeseen circumstance, no. But issues that has to do with disaster is an unforeseen circumstance. So that one could make comparison difficult. So that one, you state it in your introduction, that the fire outbreak will make comparison of the financial statement very difficult. However, we'll be comparing the performance of the entity before the fire and after the fire. What a nice analysis, nice introduction. So you need to give a very nice introduction. For example, this one, I'm saying that for example. This report covers analysis under profitability, liquidity, and gearing. How do you determine this? The ratios that you'll be asked to compute, you are supposed to group them under this. Sometimes we'll give you the required ratios. So after that, you are supposed to group them that, oh, this particular ratio is under liquidity, this one is under this one is under this, so that you know the coverage of your report. Sometimes the question will be open, assess the performance of. It tells you that you should calculate for all the 5, at least you should have 2, 2, 2, 2, 2, 3, 2, 3 of all of them to be used for your what? Analysis. Very important. When you go there and there is no income statement, then it means that you need to forget about what? Profitability ratio. No one should tell you, you should know that you need to forget about profitability ratio. If it's only statement of financial position, then you can be talking of only the 5. Only the 5 ratios out there. Okay. Sorry, you can be talking of only the other 4 categories. If it's statement of financial position only. Yeah. Okay. So that is it. I'm still on introduction. I said indicate the type of analysis and the coverage of your analysis. Very, very important. So these two, we want to see it in your introduction. So your introduction will go like, this report uses trend analysis, or you can start by saying that this report contains a trend analysis of One Touch Limited for 2017-2018, together with 8 industry averages. The analysis covers profitability, liquidity, and gearing. Full stop. You are done with the introduction. Nobody will never give you the 4 marks. You will get the 4 marks. Nobody will see this and will say, I will not give you the 4 marks. You have given me a summary of what I should be expecting. You've told me that you are comparing 2 years financial statement of the same company. And then 2, you've told me that your analysis covers profitability, liquidity, and gearing. So as I'm reading, I want to see something on profitability, liquidity, and gearing. And that is all. Very simple and straightforward. Now, let's now look at the content analysis. Content. Analysis of ratios. We are looking at content analysis. Content analysis. Now, after your introduction, you now pick the headings that you talked about. Profitability. Then now you are going to look at content analysis under profitability. Now, those in the movie industry or those in the art, they have what they call content managers. Even the TV stations, they have what they call content managers. It is not every content that is telecasted. They have to screen the content that the public must see and the content that is not consumable by the public. You should not bring it to the public for the consumption of the public. No. So content analysis, very important. Content analysis. What should we include in our content? What are we going to discuss? Very important. So content analysis. Content analysis. Content analysis. Number one, the analysis should be done under each heading. Okay. So under each heading, you tell us what the ratios that you have computed measures. So for the sake of time, you cannot pick them one by one. No. So you pick the heading. Then you tell us that this heading measures this. It's all about this. So I pick profitability. I tell you that, oh, profitability ratios measures the ability of the entity to make profit into the foreseeable future. I've said something about what? Profitability. Liquidity. I say that liquidity ratios measure the ability of the entity to meet its short-term obligations as and when they fall due. It is used to measure the ability of the entity to be able to convert its profit into cash flows. I've said something about what? Liquidity, not necessarily picking the ratios one by one. So you tell us, what does the ratio heading represent? What does the ratio heading represent? I'm reading. I don't know. You said profitability ratios. Then, what is it? What is it used for? Profitability ratio. What is it? Gen ratio. What is it? So at least 1-2 lines you are done with telling us what the ratio represents. That one alone will give you some marks. At least M1 or M2. 2 marks or 1 mark. Now, you now have to discuss the favorable ratios together. Then you discuss the unfavorable ratios together. So discuss together the favorable and unfavorable ratios. How do you discuss them? So what I'm trying to say is that let's assume that you have rows. You are discussing under profitability. You have rows: net profit margin, gross profit margin, operating profit margin, 2018, 2017. Let's assume this is 10%, this was 7%, this is 18%, this was 10%, this 35%, this was 38%, this 15%, and this was 18%. So it tells you that gross and net profit is saying that the entity is doing well. This one is saying the entity is doing well because it's increasing. Because of that, we say that this is favorable. Then this one is telling us that the entity is not doing well. So these two, we say is what? Unfavorable. So how do we discuss? You now tell us, you do a mathematical analysis. You now do a mathematical analysis. For each ratio, you do a mathematical analysis. So you do them together, favorable and unfavorable. So you tell us that the return on capital employed, that's the ROCE and the net profit margin increased by 3% and, okay, this is, let me make this one, let's say 14. Increased by 3% and 4% respectively. You see that I'm dealing with them together. The ROCE and net profit margin increased by 3% and 4% respectively. This means that the entity did well in terms of the ability to generate more wealth for shareholders. Blah, 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 blah. So you are telling us what it means. So mathematical analysis is all about the change in the ratio. It has increased by how much? If you are doing intercompany analysis, then you wouldn't be looking at a change, but you'll be looking at which one is higher. I get to know who is doing better. That's all you'll be looking at. So assuming this is for A and this for B, you just say that the ROCE of A is higher than that of what? B, which means that A is doing better than what? A. I mean, A is doing better than what? B. So that's what you are supposed to do it. If it's intercompany, you are telling us that this is higher than this, and it means that this is doing better than that. That's what we want to know. So you tell us the change and the meaning. I'm telling you how it will be marked. So this mathematical analysis will earn you a lot of marks for all the research that you are going to do. At least you get M2, 2 marks, 3 marks there. So you do it for favorable ratios and unfavorable ratios. So you are the change, you only telling us increase and decrease. And the meaning, we have already learned whether they are doing well or they are not doing well. Then, still under content analysis. After telling us whether they change and whether they are doing well or not, the next thing to do is to tell us the causes of the change. The causes. Causes and recommendations. You are done. You are done with the analysis. So you are saying that ROCE and the net profit margin is increasing. What may be some of the causes? Gross profit margin is decreasing. What may be some of the causes? So gross profit margin is decreased after discussing the unfavorable, everything, and then the favorable. Just tell us that, oh, the gross profit margin and the operating profit margin may have decreased because of maybe poor advertising campaign. You were not there. This one, you are supposed to know it before you go to exam hall. That what can cause an increase in sales. You check whether the sales is increasing or it is decreasing. So if it's decreasing, it may be due to poor advertising campaign, poor sales promotion strategies. Then under the cost, you check if the problem is from the cost. Then you tell us that the entity may not be cost efficient, and this one you are supposed to blame the production department, where you just tell us something that there may be a deficiency in the production department, and I'm in the production or purchasing, I'm in department. You tell us. Then out of these courses, you give us a recommendation. You can tell us that if sales is reducing, it may be due to the fact that we have not been able to improve the quality of our product. So you recommend that the quality of the product should be improved and the entity should embark on rebranding so that more people will have confidence in the product and then patronize it. You can talk of the fact that they should deepen or intensify their sales promotion strategy. They should look for a winning strategy that will win more sales for them. You get to know that the debtors collection period is going up. What will be the cause? You tell us that there may be weaknesses in the credit control system, or the credit control department may not be efficient. So what will be your recommendation? What will be your recommendation? They should strengthen the credit control system of what? The company. It's very simple. So the cost that you give for the change, out of that cost, you look at the cost and then you give a recommendation. You don't write any cost that you don't have recommendation for. So as you are writing the course, you know that, oh, I recommend that they should do this. That's all about analysis. It's very simple. Answer these questions and you will get 20 over 20. Under your content analysis, ask yourself, what does the ratio heading represent? Then after that, under that I'm ratio heading, you pick the ratio that you want to discuss. Which of them is favorable, which of them is unfavorable, you group them. The favorable ones are the ones that shows that the entity is doing well. The unfavorable ones are the ones that shows that the entity is not doing well. You group them together. Because you are going to discuss them together because of time. So you tell us that so and so increased by this respectively, by this and this respectively. It means that the entity is doing well in terms of this and this. Then you come and pick the unfavorable ones too. You tell us. Then after that, you go to causes and recommendations. What are some of the causes and recommendations? So you just tell us that the better performance in terms of gross and net profits may be as a result of or can be attributed to this and this. The entity should do this and this. We don't want you to go and write that, especially when the entity is doing well. We see students, writing, the entity should keep on doing what they are doing. What are they doing? What were they doing? We don't want to see that statement, they should keep on doing what they were doing. No. If it's advertising campaign or sales promotion strategy that you think that is good, maybe the performance is good, so you wrote that this may be due to a good sales promotion or strategy. You just, when it comes to the recommendation, you just state that they should deepen their current sales promotion strategy. You don't tell her that they should keep on doing what they are doing. No, we will not take that from you. So you should know how to analyze it. Under content analysis, for each heading, you tell us what it represents. Then you discuss together the favorable and unfavorable. You look at the mathematical analysis, the change and what it means. After that, you tell us the causes. What do you think? It may not be in the question, but what do you think will be some of the causes of that change? And what recommendation can you give? We are done. We are done. You are done. You are done with analysis. I'm done. Very simple. Okay. So we look at conclusion. Conclusion. You will see that if the entity is doing well, you know. The entity is not doing well, you know. So in conclusion, you need to tell us the performance, the general performance of the entity in terms of the coverage. Maybe the entity is doing well in terms of profitability, but they are a bit weak in terms of, let's say, efficiency. So in the conclusion, you just say that, oh, in as much as the entity is doing well in profitability, the entity was weak in terms of efficiency, and recommend that they find ways of improving their systems to be able to be more efficient. You can even pick one of your recommendations, then you come and put it under the conclusion as well. So conclusion, you are telling us general performance, the general performance. The headings with good performance. You need to highlight it. And then the headings with weak performance. We believe that the entity may not be doing well as a whole. There may be something that may be wrong with the company. So you have provided remedies for those weaknesses, and those places, areas that they did well, you have highlighted, telling them that they should take advantage of that and then sustain that good performance. That's all. So you have this question, one that you are going to do calculation and then you interpret, then one that you are going to interpret straight away. So what I will be doing is that when we meet on Zoom, after that is at the end of week 2, when we meet on Zoom, the first thing to do is to solve those 2 questions you do, at least if not 2, cry 1. Then we know how to analyze it. I want you to solve it yourself with the explanation that you have gotten, so that when we meet, I can take more of your questions as well. That, oh, so when I was going through the computation, I realized that there was a problem here. When I was interpreting, I realized I had a challenge here. Those are the things that we want to discuss in the Zoom. The Zoom is not for teaching. It's for taking your issues on the video after you have learned, after you have gone to the video and learned yourself, your issues in the video. We want to discuss it and to also solve additional questions and answers after taking your questions on the video, so that it makes you whole. You'll be fine and then pass the exam for us. Okay. So in summary, we've looked at, in week 1, you are going to have interpretation of financial statement. An interpretation for the purpose of financial reporting students. You are supposed to know common size statement, value added statement, and then interpretation of financial statement. Then corporate reporting student, the common size, value added statement, and accounting ratios and analysis. But for corporate reporting students, your concentration should be on ratio. In fact, both financial reporting and corporate reporting, the one that will come to exam will be ratio and analysis. But you are supposed to know all this. Sometimes in the public sector exam, they will give you question, you are supposed to prepare common size. If you don't know, you don't know. So you are supposed to know this, so that if they ask you in other subjects, you can be able to apply them. Especially at the level 3 students, you have case study. And in the case study, they can ask you to prepare value added statement. They can ask you to prepare common size statement. they can ask you to use the ratios. So try and go through all of them. But for the purpose of your exam, the concentration will be on the accounting ratios and analysis and ratio analysis. The concentration is on ratio analysis. Shall we pray? Heavenly Father, we thank you so much for learning with us. We pray that the little we have learned today, you bless it for us, so that very day we can be able to write our exam and pass. And at the end, glory and adoration shall be given unto your name. This and many more we ask in the name of the Father, and of the Son, and of the Holy Spirit. Amen. Shalom.